Hi, I'm Peter Rose, founder of Longwood Currency Trading. How long does it take to evaluate a Forex position? In other words, how long does it take to determine whether you've got an entry or not? That's a pretty simple process, but everybody seems to make it so complicated. Before I get into that, I'm standing out here in the back looking at this huge snow pile and we have another storm on the way here for probably starting later this afternoon, and we're looking at maybe another foot. That's a lot of snow considering this mess. And as you can see over here from the snow depth chair, the famous snow depth chair. Geez, I've had a couple of comments about this chair here. To the deck of the chair there is probably 16 inches or so, and so that's what we've got on the ground. This is March of 2023, and actually mid-March, and actually I'm recording this on the 6th anniversary of moving into this house in the mountains. So you get used to the snow. How do you get used to making a simple, excuse me, a simple and quick analysis so that you can get on with your life? I decided to come in because it's starting to get kind of cold out, and a cup of coffee will do me great. And if I start flapping my arms around, I'm going to spill that coffee. I don't want to beat this thing to death. The problems, I believe, with the Forex educational market is that the folks that came into Forex back, oh, I don't know, 10 years ago or so as retail traders, maybe starting in, 15 years ago, something like that. They all came out of the stock market environment where there's all this fundamental analysis and technical analysis, and some of that is applicable to stocks because of the underlying function of the stock market, and to a certain degree in the commodities market too, because you're dealing with finite things. You're dealing with GM stock, or you're dealing with the price of wheat or something like that. But those things are not translatable. I believe they are not translatable, and I've been looking at the financial markets since the early 1970s. I don't think most of that is transferable into the currency markets, because the currency markets are different. They're massive. Today they're almost $7 trillion a day in the currency market. That dwarfs all of the stock market volume put together, all the markets. You can't use tools for solving one set of problems that are very specific to looking at 10K reports on stocks and you know, is the president of the company going off the toilet seat and going crazy and making bad decisions? Did the treasurer abscond with money? You know, how's the new product being received by the population that's using that product? What's the perceived, I mean, all those kinds of things. Is there going to be a drought and dry up the wheat fields? I mean, there is analysis to look at specific things like that. But how do you look at the whole economy of a country? I mean, there's PhDs in economics that get together in a room with dozens of other PhDs in economics and math and sociology and all the rest of this stuff, and they try to ferret all this stuff out. And if you go to the Forex sites, you get these guys that are paid really big money to report. You know, so one day the guy is saying, well, you know, because blah 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 blah, and you know, the price went up because of this. But you know, we're looking for XYZ to happen, and so therefore price will continue to go to here. But it doesn't go to there. It goes somewhere else. And then they come in the next article or the report and they go, well, the reason it did this was because of blah, 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 and there was only a 40% chance it was going to go. They don't know what the fuck they're talking about because they're applying the wrong rules. Those rules in the currency market for how you evaluate, what are you evaluating? You're evaluating all of the component parts of the economy of two countries. Interest rate policy, political strife or activity. When do the different financial reports come out about the company? The non-farm payrolls for example the United States, the PPI. What or the CPI? I mean, what? How do you correlate all that? Well, the problem is that you can't. Even the PhDs can't. And though they say they do, if you get a room full of 10 of them, you're going to have 10 different opinions, or at least 6. So what are you supposed to do? What are you supposed to do? How do you look at get up in the morning and look at a chart and make a decision as to whether you're going to bid ask? How do you do that in a simple fashion? Remember, we're retail traders, not institutional traders. If you're an institutional trader, you're trading for a different purpose, you're trading in a different manner, you're looking at different things, and you're responding to different events. Those events are the orders that your customers are giving to you in order to transact. Or if you're on the storage side of the investment institution, then you're either just buying different currencies so that you have them in stock, so when somebody wants them, you can sell them to them. Those are the two, and then you trade, and then a lot of the institutions trade for their own bulk too. But those are the three processes of institutional involvement in the currency market. We don't have anything to do with any one of those three methodologies, and yet you have bank traders telling you as a retail trader how you should trade or how you should look at trading. Does that make any sense? The retail trader has a specific goal. It's not to create policy, it's simply to follow it and take advantage of it without creating any waves. You're not going to fight the market. The market doesn't give a shit what you think should happen or whatever. I get caught with this all the time. I enjoy economics. I enjoy reading about the different countries and what the interest rate policies are and all that rest of that stuff. But what happens is that interest turns to an opinion, and then I get stuck and I'll run tens of thousands of dollars in the red before the real when component of that analysis should have indicated that that's when I should get into the trade, or maybe I should fade my opinion and go on the other side, because you just get it wrong. When we try to form opinions and stuff, we get it wrong, because that's not what we're supposed to be doing as retail traders. We're supposed to be looking at the market, which is the chart. You pop the chart up on your screen, and remember, I've been looking at these charts since the mid-1970s, early 1970s. When you'd have to have the daily charts, when I was doing looking at commodities, you'd get the charts on on Monday or Friday, it was whatever it was for that week. You'd get those charts on Monday, and then you knew what happened last week, and then during the course of the next week you'd draw on the charts. You'd physically draw with pencil on the charts where price action was, until you get the next chart the next week. That was our charts. Now you just turn the computer on and flash it up on your trading platform. So what are you supposed to do when you get there to make things simple? The question to ask is there a trade to be made right now, or maybe in the next 15 minutes or 45 minutes? Because I don't want to take my trading day more than 2 hours of active work. Now, I'm retired, so I can go in and out and whatever. But I'm on the East Coast of the United States, so I've got some currency pairs that are very active from, New York open time until about noon. Noon our time is 5 o'clock or so in the Eurozone and England. So things start to slow down. So I can get up and start looking at pricing from anywhere from 2:30 in the morning on through to about noon. The problem with looking at, because in Europe, London Open is like 2:30 in the morning, 3 o'clock in the morning, Eastern time. But what are they opening to? They're not opening to USD because it's 2:30 in the morning. But that doesn't mean that the pound and the euro and the Swissy aren't active, because they're trading amongst each other. And there's folks that are running all-night desks in some of the institutions, so that AUD and NZD can interact with a Swissy or a cable and do some economic business. I mean, you have to. You can't just trade when everybody's awake. You have to make allowances for that. But for the bulk of the trading, it's when New York and Europe are open for business. That's when you're going to get the most of it. So if you live somewhere else, you're going to have to find some other currency pair. Regardless of that, if you can't come in, turn your trading platform on and look at price action, and I mean, look, you're not looking at one candle bar saying, well, this is what happened in the last 15 minutes or this is what happened in the last 4 hours. You're looking at maybe 100 of those bars. So if you're on a 4-hour chart, it's 100 times 4. If you're looking at a 15-minute chart, it's 15 minutes times 100. So you've got a broad picture of what happened in the past, so you get an idea of what's happening with order flow. If you have low volatility and low momentum, and the two were different, then you might say there's not much to do on the higher level charts. I can't tell anything because the bars for the currency pair that you trade, maybe those bars are not even what the average ATR is. Remember, the ATR is over 14 periods. So if you're looking at well, I don't know, take a 4-hour chart, and your ATR is back over the last 14 4-hour periods, you're getting a really broad spectrum of pricing. However, that ATR is drastically affected by the fact that the markets that you're looking at are probably only really active when the two pair countries are open for business at the same time, right? And so when they're not open for business, I mean, if you look at pound dollar, for example, in light of East Coast U.S. time, when you get to around 4 o'clock or 5 o'clock in the afternoon, you've got a damped harmonic oscillator. You've got price going along like this, and then it just goes like that. So you have this parabolic drops on each side, honing in on it. So you're looking at this, and even if you go into a 4-hour chart, you get that. But looking at a 15-minute, I mean, it's pretty dramatic. So you look at that and you go, well, I mean, for some reason, we're in this chattering, very low ATR range. We have to look at what's the average ATR during active trading. You can't just look at the ATR in general. I mean, Jesus, you have to use some sense here. I mean, here I am, I'm talking away for 4 or 5 minutes. I could have looked at my chart, decided not to trade, and already had drunk half my coffee by the time I've taken in explaining this stuff. You don't have to do any calculations or wring your hands. You just look at the chart. Geez, it looks like a flat line. Well, if I want to trade, maybe I'll drop down to the 1 minute. Let's see what that looks like. You might be able to get the 1 minute maybe having a quarter pip ATR. But it may be going up and down in 5-minute increments for a 5-period chart time frame, where you might be able to get 5 pips. I mean, when price is in those quiet zones, you can see a small trend rising. Now, most of the time, you don't get that small trend. But if there is one, what's wrong with grabbing 5 pips and then closing down and going to work? look, if you're trading a 10 lot, 5 pips is $500, right? 100 bucks a pip. So you could still make money even when in the absence of all the volatility and high ATRs and activity and all the rest of the stuff. You just have to be really careful. So when you look at that, you have to determine, where does your skill as a trader lie? Are you a long-term position trader? In which case all that shit doesn't make any difference to you at all. You're out there on the daily, weekly charts kind of looking at what you think is going to happen, and you're going to have to know some economic theory at that point, because you're looking to project out what price could do or should do in the next 60 days or the next 3-4 months. Whereas if you're a day trader, which I feel is much safer, because all I'm concerned about is what's going to happen in the next 2 hours that I want to trade, I can look at that and I can go, I don't care about the interest rate policies. I don't care about, well, I do if I'm going to get an NFP release or a Fed rate statement or something like that. I may not want to be in there trading. So you at least have to be aware of when these news releases are going to come out, because you're going to get a lot of volatility. We had one of the last NFP that came out. We had a 15-minute bar that was like 60 pips. So, you know, you just have to be careful around those times. You don't have to know anything about NFP or CPI or anything like that. You just have to know that there are events that may cause disruptions in the market. You have to know when the two-pair countries are going to be least active, and you get this damped harmonic oscillator type pricing. So you say, well, you know, I got to get to work early today, and so I got up during one of these periods of just beginning to come out of this harmonic oscillator thing. But I'm not gonna trade today. I'm just gonna go to work. Or you could sit down and you could look at things and you say, let's look at this. I've got a trend bias based on maybe the 4-hour chart. Even though you're trading on a 5-minute, I've got a trend bias that says this is going to go up, or has been going up. It appears that it's going to continue to go up. I look at the current volatility of price. Is that because that disrupts momentum predictability? And then you look at the momentum of price itself, which is a differential between the ATR of the current time frame and current candle size, for example. That's not all there is to it, but you just look at the momentum. The momentum is how stable is the trend in motion. Are the candles printing larger and larger, indicating that there's buying activity for that price to continue to go up? If you have that trend going up on small candle differential to ATR, then that thing could drop and turn around on a heartbeat. Everybody could say, this isn't going up as fast as I wanted it to. Or the institutional traders are at the limit of where they are willing to pay for something or whatever condition it is, and they're just now trying to complete as much of that order at that price. That's the best they're going to be able to get, and so they're trying to complete their orders at that price. And then when they get done, there's no more buying to be done, because that particular order, or maybe they were finishing off a $3 or $4 billion order for manufacturing parts or something. So when they're done, they step back from their desk and they go to lunch. So where's the buying power going to come from? Well, there isn't any, and so down it goes. So you have to watch out for stuff like that. How difficult is it to learn how to do that? It's very difficult to learn how to do that if you're trying to watch videos and if you're trying to read a book to determine this stuff, because you don't have the ability to ask a question. There's no interactiveness with it. Even the guys that are in there showing charts on the video, and they're going through and doing it. I pick holes in that stuff all the time. Oh, you did an engulfing candle pattern here. Why didn't you use this engulfing candle pattern here? You defined it to be this, but you're cherry picking that. Why? Because you don't really understand what you're doing. You know? That's the first thing that I look at, is if they're describing a pattern. Wait. Yeah. So that was Sue coming in with the bow dog. They were out for a walk in the woods, trying to get a final walk in before the snow starts. And anyway, there's chaos inside right now, so I'm going to come out and finish this video. We're talking about volatility and the momentum and stuff. So you're looking at the chart. You just look at it. What's price doing? Is it moving or is it not moving? If it isn't moving, will it move in the next 15 or 20 minutes? If it doesn't look like it has that, and there's certain indicators, but you can't look at somebody on a, like I said, in a video, even when they're doing a chart and they have the price out and they say, oh, because of blah, 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 that's why I did it. Well, blah, 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 blah is happening even before that. Why didn't you do what you're ever going to do when that happened back there? And that's why I don't show charts or anything. If I'm going to draw on the board, I draw squiggly lines. I don't want to draw real candles or anything, because then you're going to be trying to look to duplicate exactly what you're seeing as a pattern there. But there are no patterns. I've talked about this. There are no setups. There's indicator usage is just crazy. It's just crazy stupid to try to do that. So you can't rely on those types of things, nor should you be relying on those types of things, because they really don't make any sense for the retail trader. They really don't. However, we do have an advantage in the fact that, as I just did a video the other day, we don't have to trade. We can stand there at the edge of the craps table and we don't have to put our money down until we choose to do so. The advantage that we have over the craps table, as I mentioned in that last video, is that we can pull our money off the table anytime. We can make a bet and, oh, I don't like that, and pull it off. On the craps table, once you put your money down, you're done. You got to wait till you win or lose. So the trick in having a simple and quick methodology for determining if there's a trade available is to throw out all this stuff that you have in your head about indicators and fundamental analysis and everything else, and look. You have to understand what the Forex market is. What is it? What's it trying to do? And it is not you, the retail trader. You're not the dog in this. You're the tail. The dog is the big institutional trader that's actually conducting business. All we're trying to do is predict what that business is, if you want to make it difficult, because then you're looking about what will the volume of order flow necessary to do this guy's $6 billion order. But we don't know he's got a $6 billion order. There's so many things that we don't know. So all these guys that are writing articles about manufacturing indexes and this is going on and that's going on, they don't know shit. They don't know shit. They don't know what Frank down at Edwards Manufacturing is going to do when he picks up that phone. They don't know what his order size is. And even if they did, they wouldn't know what everybody else's order sizes are. They don't know which institutions are going to be handling it. They don't know who the guy is that's going to be doing that may trade differently than the guys at some other place. So you really don't have to worry about any of that stuff. What you need to worry about is to simply look at current price action as a function of what time it is right now in relationship to your projection of where that might be in 2 hours. And it's all a guesstimate. As the famous hockey player Wayne Gretzky put it, I skate to where the puck is going to be, not where it is. And that's what we should be doing in our retail currency trading, is skating to where the puck is going to be, looking to where the price should be. Where should that price be based on what it's doing right now? And if in the next 15 minutes it doesn't continue in that direction, you don't have a trade entry. So it takes about 15 minutes looking at a 5-minute chart in order to determine whether the price is continuing on in that direction. The likelihood the probabilistic estimate that you're really trying to deal with is, and it's the same as estimating if you're going to get a 10 card in 21. And you're just adding up numbers, and you're estimating the probability that the next card that you hit won't take you over 21, right? And so you're looking at that price action in that 15-minute period of time, and you're saying, oh yeah, man, that looks like it's going to go. It's got the juice to go. So you put your order in, put your stop in, set your profit target, and forget about it. If you are trading multiple lots and you're going to be doing staging, oh, okay, well, that's something that I can talk to you about doing that. I mean, I've got part of my course is like 30 or 40 pages just on large scale lot size position management. And so because trading becomes different, the rules become different as to the when component when you're trading multiple lots than they are if you're just trading small lot sizes, like a couple of 3 lots, and you're all in, all out. But the whole thrust of making things easy is to look at what's happening on the chart right now. Is there some kind of trend or bias for the price to be moving up or down? What's the momentum? So you're going to get a gauge for how strong that movement is. And then you estimate, well, how long is that going to last? But it's 3 really simple steps, yeah? Now, it takes some experience to do that, and you're not going to learn it by looking at a book. And it's very difficult to learn it from some guy that's standing out there in front of a camera showing his charts, because you're not in real time with that, and you're not able to ask questions. Well, you're doing this here, but you didn't do it there. Why? Well, I was asleep here, and I got to do it here. But that's generally not the issue, right? Because they're there during those periods. So it's so easy to do something after the fact. The trick is, how do you do it in real time right then? And that's how you make things simple, is by doing exactly what I said. You look at the chart, you see if there's a little bit of a trend bias there caused by the momentum, is number one. Number two, is that momentum strong enough to have a continuation of that bias of trend? And if it is strong enough, then strong enough means how far could that price go? Will it go to, do you have a profit target that's 20 or 30 pips away? Because you're going to have to wait 4 or 5 pips, 8 pips, in order to confirm that price is got the juice to move toward that profit level. You're going to enter, and then it's going to go ahead for 5 pips or 12 pips or whatever it is before it starts to have a little bit of a retracement. And then you got to make the determination. Do I want to get out because this may be a major retracement and it's going as far as it can go? Or is this just a simple glitch, and then I'm gonna hang in there, I'm going to stay with it? That's where the real trading comes in. But the entry level, you got to keep that simple, or you're never going to make the trade. You're going to wring your hands, and you're going to second guess yourself every time you make the trade. Don't. Learn a simple method of looking and evaluating price action so that you can have the confidence that you make the trade. And then, once that trade is made, if you have buyer's remorse, get out. Because if you're not feeling good about the trade, you're going to make wrong decisions later on about it. Keep it simple. Really, that's all you need to do. Keep it simple. Easy for me to say, right? No, it isn't. It cost me $40,000 to learn this. I don't know how you're going to learn it. But think about this stuff, please. If you have any questions, throw me an email. There's not much I can do in a comment. I appreciate your comments. But if you want me to try to work with you and try to resolve some stuff, then let's do it through email. Okay. Well, I'm going to go in because I'm cold. It's just now starting to spit some snow. So I'm done for the day. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.